Welcome to the Opening Bell Report.
We are talking about a tiny, and I mean tiny, microcap company called OLB Group, ticker OLB. Before yesterday, February 17th, 2026, most people, even fintech people, had probably never even heard of them.
Never. And then bam, they jumped 256%.
Yeah.
In a single session.
It just completely takes over the screen.
Oh yeah, it sucks all the oxygen out of the room.
And the reason for this complete explosion, one word, or, well, one very, very big partner. PayPal.
It's the classic headline, isn't it?
Oh,
The
yeah.
David and Goliath story. You have this tiny $10 million company that announces a deal with a, $40 billion giant. And the market just completely loses its mind.
So that is exactly what we're going to unpack today. We've got our hands on a really interesting analysis report titled OLB Group and the PayPal Pivot. And our mission for this deep dive is pretty simple. We're going to play detective.
I like it.
We have to figure out if this is a genuine Cinderella story, you know, the little guy finally making it big, or if this is a kind of trap set by market mechanics. Because when a stock goes from under 50 cents to almost $2 in a few hours, you have to ask questions.
You absolutely do. And the answer is almost always way more complicated than just stock go up. We got to separate the hype from the, let's call it the plumbing of the market.
Okay, let's start with that headline story, the event itself. Walk us through what actually happened when that opening bell rang yesterday.
Well, context is everything here. You have to understand where OLB was starting from. I mean, before this news drop, OLB was trading at around 40 cents. It was a penny stock in the truest sense of the word, just invisible.
40 cents, okay. And then the news hits.
And it just goes parabolic. It surged all the way to a high of $1.80.
That's the 256% gain. I mean, if you'd put $1,000 in that morning, you'd have had over $3.5 grand by lunchtime.
That's the lottery ticket dream right there.
Yeah.
But what's even crazier to me is the volume. We saw over 400 million shares change hands.
Wait, hold on. 400 million for a company this small.
We'll get into why that number is so nuts in a minute. But yes, it was a total frenzy.
So the catalyst was this PayPal deal. But let's be specific, because partnership is a word that gets thrown around a lot. What exactly did OLB secure here?
This is the good news for the bulls. It's a real substantive integration deal. So OLB has this payment gateway called SecurePay. This deal embeds PayPal's entire suite of options directly into it.
So if I'm a small merchant using OLB for my payments, what does this actually change for me?
It changes the whole checkout experience. Before, you might need a developer, you might need to mess with APIs. It's friction. Now, if you're one of OLB's 10,000 merchants, you can basically just flip a switch.
And suddenly I have PayPal.
You get everything. PayPal checkout, pay later, PayPal credit, and this is the big one, Venmo.
I feel like Venmo is the magic word here.
It is the absolute buzzword. You have to look at the demographic shift. I mean, Gen Z, younger millennials, they live on Venmo. For a small shop to suddenly accept it without a headache, that's a legitimate value proposition.
It just removes all that friction.
Exactly.
Yeah.
And buy now, pay later is huge too. So for OLB's merchants, this is a very tangible, very attractive upgrade. And the report says this begins immediately, Q1 2026. This isn't some promise for 3 years down the line.
Okay, so the product update is real, it's useful, but let's pivot. Does a feature update, even a good one, justify a company tripling in value in 6 hours?
That is the million-dollar question. And to answer it, we have to look at the before picture. You just can't understand the surge without knowing how deep of a hole OLB was in.
Right, the analysis report has a whole section on this, the tiny stock reality. So paint that picture for us. How were they doing before PayPal came along?
To put it politely, they were in distress. To put it bluntly, they were fighting for their lives. The report calls it the ugly truth, and they are not exaggerating.
Okay, give us the numbers. How bad was it?
Trailing 12-month revenue was about $9.6 million, and that number was shrinking year over year.
Oof, not good.
But the scary number, the one that keeps you up at night, is the net loss. They lost $11.2 million.
Wait, run that by me again? They brought in $9.6 million and lost $11.2.
Correct. They lost more money than they actually made in sales. For every dollar they brought in, more than $1 went flying out the back. It's not sustainable.
So how are they even keeping the lights on?
Well, the report says their cash position was critical. They were staying alive by issuing more shares dilutive offerings just to pay the bills.
Right.
Basically selling off parts of the company to pay rent.
That sounds incredibly fragile.
It gets worse. They were actually facing a delisting notice from NASDAQ.
Right, I saw that.
Right.
Because they were trading under $1 a share.
Exactly. NASDAQ has rules. You have to stay above $1. If you don't, they kick you off the exchange. And getting delisted is a death sentence. Big investors can't touch you anymore. You end up on the pink sheets.
So this PayPal deal, It wasn't just about getting a cool new feature.
No, not at all. It was a survival mechanism. By attaching their name to PayPal, they weren't just trying to get more users. They were trying to pump the stock price back over that $1 mark to avoid getting kicked off the stock market.
Which brings us to the mechanics. Because you said earlier, the stock didn't triple because the business changed overnight.
No, absolutely not. The fundamentals today are the same as they were 2 days ago. They're still losing money. The surge was driven by market mechanics. A perfect storm of three things, really. Algorithms, float, and shorts.
Okay, let's unpack those. This is the real lesson. Let's start with the algorithms, the name drop effect.
Right. So much of today's trading isn't done by humans. It's bots, scanning news wires at lightning speed. And they're just looking for keywords.
Like PayPal.
Exactly. So a bot is programmed to see a headline, OLB Group partners with PayPal. And it just executes by orders. Instantly, before a person has even finished reading the sentence.
It's like a digital reflex action.
It is. A $10 million company gets mentioned with PayPal. Buy. But then all that buying pressure slams into the second factor, the float.
The low float concept. Break that down for us. What is float?
The float is just the number of shares actually available for the public to trade. OLB has a tiny float, only about 1.89 million shares. It's minuscule.
Okay, so not many shares to go around.
Exactly. Now combine that with the 400 million shares that traded yesterday.
I'm still trying to wrap my head around that. 400 million shares traded, but only about 2 million exist.
It means every single available share changed hands, 200 times? In one day.
That's dizzying.
It is. The report has a great analogy. It's like trying to push a fire hose of water through a tiny drinking straw.
I can picture that.
The water is all that demand from the bots. The straw is the tiny supply of shares. When you force that much pressure through that small an opening, the price has nowhere to go but straight up.
And then you add the third ingredient just to, pour gasoline on the fire. The shorts.
The short squeeze.
Right.
Before yesterday, betting against OLB was a smart trade. They were losing money, about to be delisted, so people were shorting it.
But then the price starts rocketing up.
And those short sellers are losing a ton of money, fast. And the only way to stop losing money on a short position is to buy the stock.
So you have bots buying, momentum traders buying, and now you have short sellers forced to buy to save themselves.
That's the feedback loop.
Yeah.
It's a panic. That is how you get a 250% move. It had nothing to do with the value of a Venmo button. It was about the lack of available shares.
A perfect storm. Okay, so now that the initial explosion has happened, let's look at the long term. The analysis report breaks this down into a bull case and a bear case.
The optimist versus the skeptic.
Right. Let's start with the bull case. If you're an optimist, what are you seeing here?
You're seeing validation. You're saying PayPal doesn't partner with broken tech.
Good point. They have a reputation to protect.
Exactly. They wouldn't risk their brand on a gateway that's going to crash. They must have vetted OLB's tech. So that stamp of approval, it tells the market that the tech stack actually works.
And there's a margin argument in there too, right?
Yeah. If OLB can take a small fee on top of the PayPal volume, the quality of their revenue could really improve.
Okay, but the report also mentions a hidden bonus, something about Bitcoin.
Ah, yes, the wild card. So OLB has this weird subsidiary called Dement. It's a Bitcoin mining operation.
That seems completely unrelated to payment processing.
It is a bit of a mess.
Yeah.
But the plan is to spin Dement off into its own company. So the bull argument is, if you buy OLB now, you're getting the fintech business plus a free lottery ticket for a Bitcoin miner later on.
A 2-for-1 special. I can see the appeal. Okay, now let's put on the skeptic's hat. The report calls the bear case the trap.
Right. The bear case is all about reality crashing the party. First point is execution lag. A partnership agreement is just a piece of paper. It's not cash.
The report says the financial impact won't show for 6 to 9 months.
Exactly. The stock tripled yesterday, but the company won't see a dime of profit from this for half a year. That's a long time for the market to wait.
And in the meantime, they're still burning cash.
Which leads to the single biggest danger, and the one thing I really want listeners to understand: dilution.
Explain that. Usually a high stock price is a good thing, right?
Well, remember, OLB desperately needs money. When their stock suddenly spikes to $1.80, that is the perfect time for the company to sell new shares to the public to raise cash.
Because they can get more money for fewer shares.
Exactly. It's a logical move for the company. But for you, the existing shareholder, it's terrible.
Because it just floods the market with new supply.
It dilutes your ownership. And when a company does that, the stock price almost always crashes back down. That tiny straw suddenly becomes a wide open pipe, and all the pressure disappears.
And the report mentioned the stock already dropped in after-hours trading.
It gapped down to 99 cents after the close. That tells you that the smart money, the people who understand this dilution risk, are probably already taking profits.
And what about the competition? I mean, is this really that innovative?
That's the third bear point. Saturation, Stripe, Shopify, Square. They all have this already. OLB is just playing catch up. They're not inventing a new wheel. They're just finally putting the same tires on their car that everyone else has.
So it's not unique, it's just necessary to stay in the game.
Precisely. It's table stakes for 2026.
So bringing it all together, what's the verdict?
The verdict is that this was a lifeline, not a lottery win. The market celebrated because OLB won't go bankrupt tomorrow. The PayPal deal bought them time, and, crucially, it might save them from being delisted.
But the trading reality is still incredibly volatile.
Extremely. The report highlights the $1 mark. That's the battleground. If the stock stays above $1, they stay on NASDAQ and they can try to rebuild. But if it breaks below $1,
The gap fills.
that empty space on the chart, the price often slides right back down through it. It could go right back to 60 cents once the hype evaporates.
And there's a great quote in the report that sums it all up. For this to be a long-term investment, they need to turn that PayPal logo into actual profit dollars.
And that's the hard part. Announcing a deal is easy. Executing on it is the grind. Right now, this is a dangerous trade. It is not yet a sound investment.
It's fascinating how market psychology works. We see a logo we trust, like PayPal, and we just project all that stability onto this tiny, struggling company.
It's the halo effect. And in an algorithmic world, that halo is amplified 1,000 times by speed. The bots don't care about the balance sheet. They care about the keyword association. But eventually, the humans wake up, look at the numbers and say, wait a minute.
And that wait a minute moment is what we're seeing in that after-hours drop.
Exactly. The gravity of financial reality always sets in.
Okay, so as we wrap this up, we went from a dying stock at 40 cents to a market darling at 180. And now we're just watching to see if it can hold that $1 line.
The next few days are critical. If they announce a share offering to raise cash, the price will probably tank, but the company might survive long term. If they don't, the price might hold up for a bit, but that bankruptcy risk is still there. It's a game of chicken.
A game of chicken with millions of dollars on the line. I love it.
It is never boring.
It certainly isn't. So to leave our listeners with a final thought, we saw yesterday how a blind, machine-driven reaction to a brand name can create chaos. So here's the question. In a market so dominated by algorithms, does the headline matter more than the bottom line? OLB proved yesterday that the right partner can triple your value in seconds, but only execution can keep it there.
And that execution takes a lot longer than a millisecond.
Exactly. Thanks for diving deep with us today. Keep an eye on those charts and don't let the bots push you around.
Stay curious and always check those financials.
See you next time.
Don't forget to like, share, and subscribe for more.